Tax planning can be one of the most impactful areas of financial planning where we can truly quantify the savings or the impact of our planning recommendations. I have a client situation today that I just wanted to share. I thought it was a cool story where I could really point to planning work that was done that saved the client quite a bit of money that we can pretty much point to in dollars and cents. So we were able to save this client about $33,000 in capital gains tax with the sale of a rental property. And that is using the fairly well-known Section 121 exclusion that allows you to exclude up to $250,000 or $500,000 for a married couple in capital gains if you've lived in the property for at least 2 of the last 5 years as your primary residence. Okay, so I'll talk a little bit about the law, the tax law. I'll talk a little bit about the client situation and kind of how we went about implementing the recommendation. Background, client came with a rental property that they weren't that pleased with. The mortgage on the property was about 2.5%, so pretty low. But the cash flow on the property was still relatively even. It wasn't even cash flow positive, even with that low mortgage. So the client had actually been considering selling the property for a number of years. When the client came on board as a client and brought this to me, they had not lived in that property for a few years. They were coming up actually on their 2 in 5 year mark. So it had been almost 3 years since they had moved out. We were about 5-6 months shy of it. So they had lived in it for a while. They moved out. If they sold basically in the next 6 months, they would be able to qualify for that 2 in the last 5 years rule. If they sell 1 day past, it's a weird tax law where if we sell 1 day past that 5 year mark, if we've lived in that property for 1 year, 11 months, and 20 days of the last 5 years, we cannot exclude any of that capital gain. This client was looking at a capital gain of about $150,000 on this rental, not including depreciation recapture. We're just looking at the capital gain portion. So that $150,000 we calculated would incur roughly a $33,000 capital gain tax bill. So if this client was to sell before that 5 year deadline, they would save $33,000. If they sold 1 day after that deadline, they would pay $33,000 extra to the IRS that they didn't necessarily have to. So we talked about it. I showed her what it would, cost to sell before or after that deadline. And she made the decision, hey, let's really get with a realtor, get really serious, and let's sell this thing. And we were able to sell that property about 2-3 weeks before the deadline, which was awesome. A huge win right off the bat in the first year of a relationship with this client. So pretty fun to be able to be a part of that. And especially because she was already thinking about selling the property. It wasn't something we forced her into or anything. It was more so, hey, we're already thinking about doing this. We're looking at the math. This is really good timing if we're looking at the tax implications of this. And it was something she wasn't exactly tracking. So talking a little bit about the Section 121 exclusion now. So it's 2 of the last 5 years we need to live in the property as a primary residence. There's a couple things with that. For those that are in the military that are active, that 2 in 5 becomes 2 in 15. So there's a 10-year tack on to that, okay? Pretty useful for military members. Also, if we move before the 2 years is up for things like a PCS, a job change, there's a number of things that the IRS lays out. We can actually prorate that exclusion. So if we only live there 1 year and then we move because of PCS and then we sell that property 3 years later or something, we can actually exclude $125,000 for a single filer and $250 for a married filing jointly of that capital gains. Just something to know. This actually does come up like pretty often in practice. People are moving around quite a bit. People have rental properties that wax and wane, like they like it and they don't like it. And then 2021, 2022, we had some serious capital appreciation in the real estate market. So those rentals that people were holding are gaining quite a bit in value. And then we have a pretty large capital gain sitting there. So this does come up quite a bit. Another thing to know with the Section 121 exclusion, we can only use it every 2 years. That's a pretty hard rule, right? So we can only exercise that every 2 years. So if we moved around 5 different times while we were in the military, we've got all these rentals, we get out then as a veteran and now we're looking to sell these. We can't say, oh, I lived in this one for 2 years, this one for 2, this one for 2. So I'm going to sell them all today and exclude all this gain. No. We can only actually use this exclusion every 2 years, okay, every 24 months. just a couple things to know with that exclusion. One layer deeper into this that also I think makes it even more of a home run for this client is that they had an unusually high income year in 2024. Their capital gains tax bill would have been much higher than it would have been in other years. So that's, I think, like a secondary thought in this when you're planning out, hey, does it make sense to sell this, exclude capital gains, take capital gains, whether that's real estate or stocks. I think looking proactively at your tax brackets, understanding what bracket you're in, what capital gains bracket that is it short or long term, right? Short term is going to be taxed as ordinary income. Long term, if we're holding it more than a year, is going to be taxed at long-term capital gains rates. Where are we now? Where do we think we're going to be in the future? Are we in a low income tax year? Well, actually, it might make sense to take some gains. Are we in a high income tax year? Well, does it make sense to sell a property maybe that we're able to take this exclusion on and not pay 20% capital gains rate? So I think this all plays in. I think the takeaway and the lesson as we're wrapping up here, be proactive about your tax planning. Think about what you have, real estate and stock, whatever it is, cryptocurrency, whatever you own. What are those capital gains and what are those losses? And how does that play into, your tax situation, your goals? Your goals, I think, drive all this. We don't want to let the tax tail wag the dog. We don't do something just for taxes. This client wanted to sell this property irrespective of taxes. She was disillusioned with rental property ownership. She wanted to get it off her hands. She thought, hey, it's kind of an aging building. It's probably going to have some maintenance issues. Everything kind of lined up perfectly here. But we do want to make sure that there's purpose and vision and there's a goal behind our planning that is driving us to this conclusion. We don't want to jump straight to this just because it saves money in taxes, right? So I think the takeaway is know the tax law. Section 121 is pretty cool if we can use it properly, especially for military veteran folks. 2 in the last 15 years can be pretty powerful if we time the sale of properties. And then obviously think about your goals. Do you want to sell? Do you want to just hold rentals forever? Do we want to do a 1031 exchange into another rental? This client didn't want to do that. We talked through that as well. So, just think about your goals and how that, integrates with your tax situation, your current income bracket, again, and your future income brackets. What do we think those are going to be with reasonable expectations? Tax planning is a year-round sport, and it's very forward-looking, and it doesn't come natural to most folks. And most tax preparers aren't doing it, to be honest. Most tax preparers are going to be looking at your previous tax year and trying to report that properly. I try to do the planning work as a financial planner of looking forward through the windshield, the next 5 years, the next 10 years. What are we thinking about for taxes, your income? How does that integrate with your goals, right? So this is just a little microcosm and look into, what that looks like in a client situation, how we took goals and implemented it into action with good financial planning. So I hope that this was a helpful example for you. Let me know if you have any questions. Thank you so much again for being here. I really appreciate your support. If you enjoy this podcast, please share with a friend or rate and review on Apple and Spotify. It's pretty much the only way we're growing right now is kind of organically, but I really just want this podcast to be good and people to share it and it grow that way. I don't want to shove it down anyone's throat. So thank you again for being here. We will see you back in a couple weeks. Thank you for joining us today. Do you want the exact financial planning framework that I use with clients? Go visit baskinfp.com where you can grab a free download of the ultimate military and veteran financial checklist to give you the bluff on what you need to be doing to manage your finances. We'll be back next week with some more content to help you on your journey to financial freedom. See you then.